Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Today, we continue the second of our three-part webinar series surrounding COVID-19 and the global pandemic's effect on the automotive retail market. You will all be receiving a copy of this webinar by the end of this week. This program came together within days and had everyone working over the weekend, and actually up until 20 minutes ago, to make sure the presentation could be filled with the most up-to-date information. We hope that you'll appreciate the efforts of the presenters and the materials shown today. Now join me in welcoming Dan Cheney, Kelsey Sojberg, and Sarah McKnight from Moss Adams Automotive and Dealer Services Group. With them, from Fisher & Phillips LLP, we have Carl Lindegren and Samantha Monsees. So take it away, guys.
Thank you, Rachel. This is Dan Cheney with Moss Adams. I want to start by saying good morning to the people in the West and good afternoon to the people in the East. Thank you, AIADA, for continuing to be such an important advocate for dealers. We really appreciate that. And also, big thank you for Fisher & Phillips, who last minute agreed to join this webinar and address the employment law aspects of so many of these new developments. For those attending, we know you are navigating a very challenging time while being inundated with information. Our hope today is that the presentation will clear up some of the questions and give you additional new information. We'll be sharing some of the key tax and financial aspects of the packages that are available through these new programs. We have a lot of information today and are going to be moving pretty quickly. The agenda includes the Family First Coronavirus Response Act, Paycheck Protection Program, which is the new SBA loan program, the Employee Retention Credit, delay of payment for employer federal taxes, an overview of the tax provisions in the CARES Act, the SBA Economic Injury Disaster Loan, another loan program, and review of some of the key compliance filing changes and some key takeaways. But to start it off, we're going to have Sarah McKnight from Moss Adams go over, kind of set the stage with a brief overview of the 4 payroll provisions we'll be going into detail on today. Sarah?
Great, thanks, Dan. Great, before we get into the details, I just wanted to take a few minutes to point out that there are really 4 new provisions related to payroll and potential reimbursements. They all have their own nuances. Some are potentially required. Some have provisions to avoid double dipping. They all have different applicable dates and employee count definitions. Even the definition for over 500 employees may be different from one provision to the other. So, the real important point to note here is to make sure you are working with your advisors on your specific set of facts. We're going to go into the details on these, but just, really want to make sure that you understand that there are lots of different pieces of this. So high level, the first 2, which I think everyone is most curious about, out of the Families First Coronavirus Response Act, we got the expansion of family paid leave as well as paid sick leave with some potential payroll credits for the amounts paid under that program. And then under the CARES Act, we actually got 3 new programs. There's the Paycheck Protection Program, which is the SBA loan with the potential of principal forgiveness. And then we have the Employees Retention Credit, which is the payroll credit provision for up to 50% of the wages that you're paying, up to $10,000 per employee. And then finally, after exhausting all those other opportunities, there's the potential to delay your payroll taxes between now and the end of the year. So to get us started on the details, I'd like to hand it over to Samantha and Carl of Fisher & Phillips to walk us through the details of the Family First Coronavirus Response Act. Samantha and Carl?
All right, thank you very much. I'm Samantha Monsees, and I'm joined here with Carl Lindegren. We are all practicing social distancing. Carl is at a completely different state than I am. That's how good we are at social distancing. So he cannot speak at the same time as me. Oh, you can. There you are. So we're just going to go through the FFCRA and some of the different provisions that may be unfamiliar to you if you're an organization that didn't have to comply with the Family Medical Leave Act or other leave laws in the past. This may be new and unfamiliar to you, but we're here to kind of break it down and make it as simple as possible. So just a quick overview. This law was signed into law by President Trump on March 18th, so almost 2 weeks ago. And since that time, the Department of Labor has slowly but surely been issuing some guidance about some of the holes that are in the act. as you all can imagine, whenever legislation is put together fairly quickly, there are some gray areas that attorneys like Carl and I are left to speculate. So these frequently asked questions that are listed on the Department of Labor's website help provide some clarity, but they are not true regulations, so they're not actual law. They're only a guidance, but we have been keeping up to date on those, and it helps answer some of these questions that we have about who is qualified for the leave and under what circumstances. So Carl and I are going to talk about two different provisions. One is the Emergency Paid Sick Leave, and the other is the Emergency Family and Medical Leave Act. Some people call it the expanded FMLA, but it simply expands FMLA for a covered reason related to individuals who cannot work or telework because they need to take care of a child. So we'll start with the emergency sick leave. So this is applicable to employers with fewer than 500 employees. So if you are a small business and only have a handful of employees, unfortunately, the bad news is you will have to comply with this law. The other requirement here that kind of leaves everyone scratching their head is that this is eligible to anyone who is employed by you. So if someone was hired yesterday, they are eligible for this leave. It's somewhat counterintuitive to what we know about traditional leave laws. But that's the requirement. It's just 1 day of employment. So there's 6 different qualifying reasons for emergency paid sick leave. And I've put the first 3 in green to help you remember that these are the first 3 that require the most amount of money to be paid. So these qualified reasons are available for those who cannot work or telework. So this is someone who cannot work from home and cannot work due to one of these reasons. So the first reason is the employee is subject to a federal, state, or local quarantine or isolation order related to COVID-19. The Department of Labor issued guidance that made it clear that the shelter-in-place orders that are all over the United States right now, that is not a covered reason. So if your business is shut down because the governor says you cannot operate, or however that applies to your business, that does not mean that your employees are subject to this leave unless they meet a true qualified reason. So in other words, if your business has been shut down because you've been deemed non-essential, or you're in an area where you can no longer operate simply because the various shutdowns have slowed down your business, your employees would not be able to work under that instance anyway. So that's kind of the best way to help remember it is, okay, if my employee was able to work but couldn't because of some sort of isolation order, would I have to apply benefits to them? And the answer is yes. So for those folks that cannot work because you've been shut down or you've been deemed non-essential, that is what unemployment is for. So that's different than this emergency sick leave. The second reason that is available is if the employee has been advised by a healthcare provider to self-quarantine due to concerns related to COVID, or the third reason if the employee is experiencing symptoms of COVID and seeking a medical diagnosis. The first 3 reasons are reasons that apply to the employee, and the last 3 reasons are reasons for leave qualified under the Emergency Paid Sick Leave Act for reasons related other than the employee. So this would cover if an employee needs to take care of another individual who's subject to a self-quarantine order, or perhaps has COVID or COVID-related symptoms, and also if the employee needs to take care of their son or daughter because the school or place of care is closed or unavailable. And then the last one is kind of a catch-all. That's if the employee is experiencing, quote, any other substantially similar condition as specified by HHS. So this is a little vague, but we think this was included because we simply don't know if there's going to be after effects of those who contract COVID. And so this helps to embody maybe some other issues that may come as a result of COVID without having to revise the law altogether. So if the employee is sick and is unable to come to work, so we'll toggle back here. So for these first 3 reasons that are in green, Full-time employees are entitled to 80 hours of paid sick leave, and part-time employees are entitled to 40 hours. And the part-time calculation, if it's not a true part-time, 20 hours a week, then you would do that calculation based on the employee's average number of work hours in a 2-week period. And if the employee is employed for less than 6 months, you'd simply use the average number of hours per week that the employee would normally be scheduled. So for these first 3 reasons that we've identified that are in green, those are paid at 100% of the employee's regular rate or federal or local minimum wage, whichever is higher. And this type of leave can be used intermittently, meaning it does not need to be taken all at one time. For reasons that relate to something other than the employee, so reasons related to others, the employee is also entitled to 80 hours of paid sick leave and 40 hours for part-time. However, this is paid at 2/3 the employee's regular rate or federal or local minimum wage, whichever is higher. So we kind of regroup here and go back to our qualifying reasons. So here's our review of our qualifying reasons. So reasons 1, 2, and 3, those are available at a full rate of pay, and reasons 4, 5, and 6 are available at 2/3 rate of pay. And there are caps based on each of these types of reasons. So the cap is $511 per day for reasons 1, 2, and 3. Those are our green employee-based reasons, for a total of $5,110 in the aggregate. Or for the qualifying reasons 4, 5, and 6, so those reasons we talked about that relate to others, that is paid at 2/3 rate of pay, and that's capped at $200 per day and $2,000 in the aggregate per person for any of those qualifying reasons. For those folks that are taking the 2/3 pay, you may permit them to use their other accrued time off to supplement the remaining 1/3 of the pay if the employee wants to do it. There's no prohibition against that. There are some exemptions. So an employer who employs a healthcare provider or an emergency responder, which most likely wouldn't apply to any of you, but that would be an exception. There's also an exception for small businesses with fewer than 50 employees from leave to care for a son or daughter if the imposition of such a requirement would jeopardize the viability of the business as a going concern. So we haven't gotten a lot of clarity on that, but essentially in order to be exempt, you would need to have a pretty strong business case that you could not comply with the sick leave. A couple rules before I pass it over to Carl. The sick leave does not carry over, so if the employees do not use the full time that they're allotted, it does not carry over to next year. This law ends on December 31st, 2020. And if I didn't mention it to begin with, this law goes into effect April 1st, so it goes into effect Wednesday. So effective Wednesday, if you apply and you meet the criteria that we've discussed, then you will be required to offer this leave to your employees. An employer cannot require an employee as a condition of paid leave to find a replacement. So someone is not required to find someone to cover their shift if they cannot be there for a COVID-related reason. And a really important point I want to make sure that we emphasize here is an employer cannot require an employee to use other paid leave before using the paid sick leave under this act. So the employee can choose. So in other words, if I have 2 days of state mandatory sick leave paid accrued, I can use that as part of paid sick leave before I dip into my emergency paid sick leave under the federal law. Last note before I pass it back to Carl is there are notice requirements. The Department of Labor issued a model poster, and there's a picture of it there on the right-hand side of your screen. Employers must post this notice starting Wednesday. This is to let your employees know that they have this benefit available to them. And then you're also required to let your employees know, and then there's no prohibition to you requiring your employees to follow your general call-in procedures such as you would for other paid leave. There's no prohibition against that. And I'll go ahead and pass it to Carl.
Great. And special thanks to Samantha. She's been working really hard. She's on our task force on this COVID, and I don't know when she sleeps. As Amanda said, the same threshold, basically, fewer than 500 employees. Big difference in this from what we know of FMLA that you've been dealing with for years. We no longer have the 12 months, 1,250 hours. It's 30 days prior to the need for the leave. Again, 12 weeks job protected for an employee who can't work or telework. And the reasons for this are fairly limited. It's to care for a son or daughter, 18 years or under, whose school or care place is closed. And we've gotten some guidance, as Samantha said. It seems like we get it twice a day now from Department of Labor, fleshing out a little bit more what this means. And they are broadening the definition to adult children who would need to be cared for due to mental disabilities and the like. A public health emergency, which would have to be the reason for the care, would again be something related to COVID, declared by the federal, state, or local, which I think at this point we've got the federal distancing and stuff, so folks who would be closed are on that. How does it work? It's a little bit odd. The first 10 days of the FMLA, extended FMLA, are not paid. However, the employee can substitute other paid leave or even the sick leave. And then after the 10 days, they would be paid at a 2/3 rate, similar to the provisions where you're under the sick leave caring for somebody else. And again, $200 a day is the cap with a $10,000 max, and the same exemptions under the emergency sick leave. For those small employers, again, some concern about how this would affect the business. So if you're under 25 employees, the traditional putting them back in the same or equivalent job, which is really the same job, may or may not apply. And it's a pretty onerous set of facts that you have to meet. So you'd want to walk through this with your advisor if you can't bring the person back. But you do have to, like a lot of the things that are coming out from Congress now, provide the leave, and then show that the position does not exist due to economic conditions or other changes in operating conditions of the employer that affect the employment or caused by the public health emergency, otherwise the COVID. And then you have some obligations to make reasonable efforts to put the person into another job. And maybe the most onerous, if you're going to do this, is to look for the next 1 year to putting the person back to work. And then again, you've got the poster that needs to be up, and we've got that on our website, and I think you can get it from the DOL. As this is evolving, where the leave may be foreseeable, an employee is supposed to give you leave as much as practicable. I think we'd all say in times like this, you probably don't want to be real aggressive on something like that. I'm going to try to pass this back to Samantha to cover the taxes.
Okay, so the good news is that as an employer, while you are required to offer these benefits, there are tax credits available to you. So under the emergency paid sick leave, so that's the 80 hours for full-time employees, 40 hours for part-time employees. For reasons 1, 2, and 3, so our employee most expensive reasons, it's $500 per day and $5,100 per person for a tax credit. Now that is a refundable tax credit that is applied against the employer's Social Security and Medicare taxes. And the employers are reimbursed if their costs for qualified leave, so your costs towards paying these wages, exceeds your tax liability for Social Security taxes. So for reasons 1, 2, and 3, the cap is $511 per day or $5,110 per person. For reasons 4, 5, and 6, it is $200 per day or $2,000 per person in the aggregate. And then under emergency family medical leave, which as Carl discussed, is only for the qualified reason of taking care of your child due to the school or place of care being closed. It's also capped at $200 per day for a total of $2,000 total. And I know we want to keep this fairly brief, so we have some scenarios that we can go through, but I'm going to go ahead and skip through past these, and if we have time, we'll do them at the conclusion of the webinar. A couple of frequently asked questions that we have received. I've already talked about this earlier, but the most recent DOL guidance that was issued late last week made clear that if an employer closes its business, either in whole or in part, because of lack of business or due to a government mandated shutdown, and this applies whether it's before or after April 1st, the effective date of the law, then those employees who are impacted by the closure are not entitled to benefits under the Emergency Paid Sick Leave Act or Emergency Family Medical Leave. And I'm sure all of you have heard that as part of the CARES Act, which is the most recent stimulus bill that was passed on Friday, that includes a fairly substantial unemployment benefit. So for those employees that are unable to work because you've been shut down or because you cannot operate because you've been deemed non-essential, those employees would be entitled to go to your state unemployment agency and apply for unemployment benefits. I'm going to skip through again. We can go back to some of those frequently asked questions and the scenarios at the end of the presentation if we have time, but I know there's a lot of good information here and I don't want to take up all of your guys' time, but Carl and I and the rest of our COVID task force are available to help you guys work through any of these issues from a legal standpoint. Obviously, the other folks can help you from a more of a tax standpoint. That's not our specialty, but just a few checklist things for as you're navigating these COVID-related issues. You know, if you're going to do layoffs or get rid of a substantial amount of your workforce just for a limited time and then bring them back, make sure you're consulting with counsel or a trusted advisor to make sure that you're doing those things in compliance with the applicable laws in your area. And with that, I will turn it back over to perhaps Dan.
That is correct, Samantha. Thank you so much. And Sarah's going to control the slides for me. So the first thing we're going to talk about on this is the new SBA loan program. This is a different program than the first one. This is part of the CARES Act, and it's the Payment Protection Program. So this loan, different than the first one, is accessed through your lender. And you should reach out to your bank. There's over 1,800 banks authorized, and they're adding a number of banks to that list now. Lenders are not requiring, through the program, they're not requiring application fees, closing costs, collateral, or personal guarantees. So this is really wonderful. Banks are 100% guaranteed by the Small Business Administration, and that's probably why they're not requiring those things. The program requires a maximum interest rate of 4% and a maximum term of 10 years. And the first 6 months of the payments on this loan are automatically deferred. So it's hard to imagine a scenario where this wouldn't make sense to apply for. Maximum loan amount is the lesser of 250% or basically 2.5 months of your average payroll based on what you paid in the prior year on an average monthly basis. And if that number is over 10 million, then you're capped at 10 million. Cannot be used on costs where you've received a credit. Basically, there's several provisions in this program where you can't double dip with the money. In general, it's available to businesses employing not more than 500 employees, but there's a waiver of affiliation rules in the document, and that waiver includes franchise businesses. So this only applies to dealerships that have over 500 employees. If the franchise is on the list of franchises and the franchise identifier code by the SBA and is over 500 employees, I believe it's on a location by location basis. We're still getting updated information on that, and NADA and others are working very aggressively to add basically all automobile brands to that list of franchises. So I expect they'll all be on there at one point. So there is exceptions for groups that have more than 500 employees, which is really good news. Must certify uncertainty of current economic conditions, make the loan necessary to support ongoing operations, and funds will be used to retain workers. So those are things that there's some certification requirements when you go through the application process. I'm sure your banks will be navigating that with you, but it is something to be aware of and think about. So the program has to be, you are required to use the money to fund certain things, and those include rent, utilities, interest on mortgages, payroll costs, primarily payroll costs, but it can be used for these other items as well. And payroll costs are salaries, commissions, similar compensation. It's limited to the first 100,000 of compensation per employee. It also includes group health benefits, insurance, retirement contributions, vacation, covered leave. And then on the mortgages, mortgage interest and other debt interest, rent and utilities, not the principal on the mortgages. One of the requirements is that these mortgage, utilities, leases, these items had to be in place prior to February 15th, 2020. So you can't go get a new mortgage and start paying the payments on it with these funds. And the amazing part of this program is the loan may be forgiven for the amount of the above expenses paid during the 8-week period starting with the origination of the loan. So, you have 2.5 months of payroll effectively that you'll receive in a loan, and you can pay salaries, payroll, mortgages, rent, utilities. If those expenses use up the entire amount of the loan, then the loan can be forgiven, which is, once again, amazing. Debt forgiveness is not taxable income for federal income tax purposes. There's a carve out that it's tax-free for that debt forgiveness, which is also wonderful. Unforgiven amounts will be payable at a maximum of 10 years and a 4% interest rate. So if you don't use all the funds to cover those employee costs and those specifically carved out costs, you will still have a loan and you'll have to pay it back for as long as 10 years. So there are some kind of downsides to this loan program. It can't be used, or you lose the ability to use the employee retention credit if you're using this loan program. And one of the other things that I believe Sarah's going to talk about is this deferral of paying your Social Security and Medicare taxes. You lose that deferral if you get money on this loan. And you also are held accountable to maintain a certain workforce. So a reduction in workforce will effectively reduce the amount of the loan that is forgiven. Basically, the free money portion of this will be reduced if you do reduce your workforce. But there's a carve out in there that if you rehire the people by June 30th, 2020, you will not be penalized. And so that gives a fair amount of flexibility to employers. And then as well, it's reduced by any salary reduction greater than 25% for employees making less than $100,000. So if you're reducing the amount people are being paid, the amount of the forgiveness will be reduced, and it's some math on that as well. And what I'd like to do is pass it over to Sarah to talk a little bit about employment retention credits.
Thanks, Dan. So I'm going to go over the last two payroll credit opportunities, or payroll, I guess, one credit and one deferral opportunity. So the employee retention credit is eligible to employers who either had their businesses suspended during the quarter due to a government mandate or have a significant gross receipt reduction. So less than 50% gross receipts in the current quarter when compared over the prior year's same quarter. The credit is a payroll tax credit of up to 50% or of 50% of the wages, up to $10,000 per employee per quarter, if the employer is an eligible employer. And if you have over 100 employees, the wages are for employees that are currently not working, so they have to be wages for not working employees. However, if you're under 100 employees, it's any wages. This credit's not available if you're participating in the Paycheck Protection Program or if you have wages where there's a credit associated with them with the FSCRA. So if all else fails, there's the opportunity to delay the payment of your Social Security taxes, the employer's portion of the Social Security taxes, and that's for liability that occurs between March 27th and December 31st. And then 50% of that deferral is going to be due December 31st, 2021, and then the remaining half is due December 31st, 2022. And one thing is, again, another you can't double dip situation is that you cannot participate in this deferral if you have debt forgiveness under the Payroll Protection Program. However, you don't really know if you're going to have loan forgiveness under the Payroll Protection Program until it's forgiven. So until we have more guidance on that, you have to just operate that if you're going to apply for that loan and hope to have forgiveness under it, that you just operate as if that's going to be the case. I'm now going to hand it over to Kelsey Schoberg of Moss Adams to start walking us through some of the other tax provisions of the CARE Act.
Great, thank you, Sarah. So to top it all off, the CARES Act also included a lot of tax provisions, some of which will actually impact your 2019 returns, also some that actually go back to 2018 and allow you to grab some things. So I'll walk you through the key tax changes that impact dealers and a couple that might be important to understand for your employees. So the first and one of the most significant tax provisions in the CARES Act, especially for dealers, is the change in the interest limitation threshold for 2019 and 2020. So if you remember, the Tax Cuts and Jobs Act implemented a limitation on interest expense equal to 30% of your adjusted taxable income starting in 2018. As I'm sure most of you know, the dealerships, or for dealerships, there is a provision that actually allows, floor plan interest to exceed this threshold, but it is pretty tied to your ability to take bonus depreciation. So I know you probably heard a lot about that last year. So this is really tied to your ability to take additional depreciation deductions. So the CARES Act that was just passed increased this 30% limitation to 50% for 2019 and 2020, which would allow businesses to take more interest and also for dealers kind of increase the ability for you to take bonus depreciation. If you otherwise might have been over that 30% threshold, but you're under 50%, you now can take bonus depreciation, which is really big. One really important caveat is for partnership returns. This does not apply to partnerships, this 50% threshold. Instead, the 30% threshold still applies, and there are special rules for being able to take any excess interest expense at the partner level. So really important to understand that and work with your tax advisor. If you are a partnership, look into those rules and make sure you understand that. Another key change to the interest rules will allow taxpayers to use 2019 adjusted taxable income to compute your interest limitation in 2020. So this will be really helpful as we might see profits, very likely to go down in 2020, which otherwise would, decrease your ability to take interest expense. So what this is doing is saying you can, if you want to, and if you have higher income in 19, you can use your 19 income figures to calculate how much interest expense you can take. So this will be really helpful next year. So I think kind of the final summary on this piece is we just really encourage you to work with your tax advisor to implement this change in 2019 and understand the additional benefit that this can provide. So another really significant tax provision in the CARES Act is the much long-awaited technical correction for qualified improvement property. So if you remember, an error in drafting the Tax Cuts and Jobs Act inadvertently made qualified improvement property depreciable over 39 years and not eligible for bonus depreciation. That obviously was not the intent, and it was an actual error in the law that needed to be fixed by Congress. So qualified improvement property covers a lot of the improvements that dealers make. It's effectively any improvement made to the interior portion of non-residential property. It excludes the enlargement of the building, elevator and escalator work, and internal structural framework. So, there are some things that don't qualify, but a lot of improvements that you're making would cover under this. So the correction is retroactive back to 2018, and makes all of this property eligible for bonus depreciation. So this is a really big deal for dealers, especially given the frequency of improvements made. I know we saw for our clients a lot of remodels and improvements in the last couple of years. So since this is a retroactive provision, it actually provides the opportunity to not only take additional deductions on 2019 property, but to also go back to 2018 and grab additional deductions. With cash flow being key right now, to the extent that we can maximize cash flow and bring deductions now, get refunds now, that's going to be super important. So if you did have qualified improvement property in 2018 and you want to benefit from that deduction now, one option is you can go back and amend those tax returns. However, we know that amending tax returns can be really cumbersome with many owners, so there is an option to explore with your CPA, like potentially filing an accounting method change and taking that depreciation on the 2018 property on your 2019 return without actually amending. One last really important point for this, if you do want to go back and claim additional depreciation in 2018, you really have to make sure that you were eligible for bonus depreciation in that year. So double check and work with your advisor to make sure that your 2018 return didn't actually include an election out of bonus depreciation. So the CARES Act also made some really helpful changes for net operating loss rules. First, the net operating losses that are, if you have any originating in 2018, 2019, and 2020, are now allowed to be carried back for 5 years to claim taxes paid in other years. So prior to this amendment, the losses were not allowed to be carried back at all. So this will be really impactful if you had losses in 18 and 19, or if you might have losses in 2020, the ability to carry back and get refunds of earlier tax paid. Additionally, the CARES Act removed the 80% taxable income limitation for NOLs, which effectively will allow taxpayers to utilize net operating losses to offset all other taxable income and not just 80% of it, and that's applicable through the end of 2020. Lastly, for loss rules, the Act postponed the excess business loss rules for individual taxpayers until 2020 and provided a lot of clarity in this area as well. So I think there's a lot of details in these provisions, but if you ran into a limitation in 2018, you actually have the opportunity to go back and amend and claim more of your pass-through losses if you had them. So we also wanted to point out the recovery rebate provision in the CARES Act. Obviously, most of you on the call are likely phased out of this, but I think it is important to understand this for your employees. The recovery rebate is a one-time refundable tax credit for individuals, excluding non-resident aliens and individuals who can be claimed as a dependent by another taxpayer. So the max credit is $1,200 for single taxpayers, $2,400 for joint taxpayers, and $500 for each qualifying child. And it does start to phase out at $75,000 of income for single taxpayers and $150,000 for joint taxpayers. I think one interesting point is that this credit is actually a prepayment of a 2020 tax credit, but given obviously Treasury does not have our 2020 information yet because that year is not finished, the current payment is based on the most recently filed Form 1040 or individual return. So if income is higher or lower in 2020, the actual difference will be paid out in 2020. So we're seeing a lot about timing of these, and it's looking like it will take a little bit of time to actually get cash in taxpayers' hands, but this will be pretty impactful for some of your employees. So the last tax provision we'll discuss is a couple of changes made to retirement plan distributions. The CARES Act waived the 10% penalty on COVID-19 related early distributions not to exceed $100,000 during 2020. So these distributions, if they're taken for that to help with COVID-19 related hardships, they can be repaid within 3 years, actually repaid back into your retirement. And any taxable income that would have ordinarily been reported on the distributions can be recognized over 3 years. The last item related to retirement plan changes is that the Act waived the required minimum distribution rules for 2020. So with that, I'll pass it back over to Dan, I believe, to talk about the economic injury disaster loans.
Thanks, Kelsey. So another loan program. This is the prior loan program, so not the program that came out with the CARES Act. Provides for a loan up to $2 million to meet financial and operating expenses. Loan amount will be based on your actual economic injury. This loan is applied through the SBA, not through your bank. 3.75% interest rate, and the term could be as much as 30 years, depending on your ability to repay the loan. And then there's a 1-year deferral of making payments. However, interest will accrue on the loan. So this is definitely a different loan program, and probably not quite as beneficial as the new loan program, because the new loan program through your bank gives you the forgiveness of the balance, where this one does not. But it's another loan program available to you.
So we just wanted to take a minute and point out a few of the additional changes that have come out recently. Many of you are probably aware of the change in the tax filing deadline. Has been moved from April 15th to July 15th. It also includes payments of taxes as well. The amounts due with your tax return, as well as your first quarter estimated tax payment, is not due until July 15th. So that's kind of an interesting thing, because we'll be paying second quarter estimated tax payments on June 15th, and then first quarter on July 15th. So I have a feeling those calculations are going to all work together, and especially with the downturn that we're currently experiencing, there'll be not a lot of protective payments being made. Just recently, the Treasury came out and announced that will also apply to gift tax returns as well. Many states are also making changes to their filing and payment deadlines to align with federal changes. If you're curious about your specific state and what they're doing, this link, the AICPA is doing a great job keeping it up to date on the changes that states are making. Many states are also making changes and providing relief related to filing of local taxes like business and occupation, and the submission of sales tax. So just for, if your staffing is low and your ability to pay, just check out your local state for some of those different changes. Many of you may have also recently received a notice from the IRS related to your reinsurance company or your micro captive. There's some debate right now about whether there is a requirement to respond to that notice. We're actually working, the industry is working on creating a combined response to the IRS on this issue, because we don't believe that the traditional reinsurance structure of a dealership applies in this situation.
So key takeaways, I think just being prepared for the worst. I think everybody is doing an amazing job in the industry of doing that. Seek information like you're doing today. We don't expect a quick bounce back. We're going to work our way out of this. And then 2019 taxes, if you've already finished them, you probably want to hold off on filing them and take advantage of these new changes. And obviously, we're all here to help. And the one thing I want to remind everybody of that we see just from a tax perspective is that a lot of times when the economy slows down, the tax savings you've had in the past, they will come back, kind of in a bad way. Your income goes up because the life will recapture, and inventory deferrals reverse because your inventory levels are lower. And so when you're planning your cash flow and preparing for this, some of those provisions, like being able to use the 2019 income when you're calculating your 2020 interest limitation, are important. And just looking out into the future, maximizing tax benefits for the future is also something to be prepared for, because we do anticipate at the end of 2020, maybe inventory levels and things like that will be lower. And then also, Samantha or Carl, do you have any other parting comments or additional commentary you wanted to add?
Not particularly. I didn't know if we had some time for some Q&A, or if we wanted to go through different scenarios, either under the FSCRA or the Payroll Protection Program.
I think that's fine. We can go back and do the scenarios.
All right. And Sarah, I'll let you drive if you just want to go back to the scenario tab, scenario 1. All right. So scenario 1, Sally has been employed full-time for 20 days at a company which employs 40 people. Sally's not eligible to receive any paid time off under her employer's policies. Sally has a sore throat and a fever of 100.7 and cannot report to work. Sally is waiting to be seen by her doctor. What benefits is Sally entitled to while she is not working? So let's look at some key things here. So first of all, Sally has been employed for only 20 days. So under the leave laws that we discussed under the FFCRA, she would be entitled to emergency paid sick leave
but she would not be entitled to emergency family medical leave. And it's important to note that that 30-day window of employment that qualifies an employee to take this type of leave is 30 days from the day that the leave is requested. So in other words, if you hire someone tomorrow, they will be eligible to take this leave in 30 days from tomorrow. And also, she works for a company which employs 40 people. Again, the employee count seems to trip people up, but unless you are excluded under some sort of dire economic condition that you can show to the Department of Labor, you're still going to be required to offer these benefits. So if it's before April 1st, which that would be today or tomorrow, consider placing Sally on either an unpaid leave, or you can pay her even though she's not entitled until April 1st. So this is really just a judgment call. I mean, I think everyone is concerned about the safety of their employees, and everyone's very anxious, and it's a stressful time, not only from a how am I going to get paid standpoint, but also from how am I going to stay healthy. So, just exercise your best judgment in determining, what's the best type of scenario and what can you offer this employee to minimize the impact on your business, but also to maximize your employee relations. So if it's after April 1, she would be entitled to emergency paid sick leave at that 80 hours we talked about before. This is a reason related to Sally because it's her own medical condition. So this is one of those green reasons we talked about earlier. So she'd be entitled to 80 hours at her regular rate. As we talked about already, she would not be entitled to emergency family medical leave because she was not employed at least 30 days prior to the day of her leave. And also because the only reason for emergency family medical leave is to take care of a child who is at home due to a government-ordered school closure. So we'll take a look at scenario 2. Sally has been employed full-time for 45 days at a company which employs 40 people. As of today, she has accrued 3 days of paid time off under the employer's policies. The school where Sally's 4th grade daughter attends is closed until the end of April. Sally is unable to work from home during this time. What benefits is Sally entitled to receive during this time? So if it's before April 1st, which would be today or tomorrow, you can place Sally on a leave of absence with pay by using her 3 days of accrued pay. If it's after April 1st, she would be entitled to emergency paid sick leave at 80 hours at 2/3 her regular rate of pay. So again, this is a qualified reason to take care of your child under both emergency paid sick leave and also under emergency family and medical leave. Don't let it trip you up because it's somewhat confusing, and it really shouldn't be. The first 2 weeks of emergency paid sick leave, the first 2 weeks of emergency family medical leave is unpaid. However, that same reason, which is the only qualifying reason for emergency family and medical leave, is also a qualified reason under emergency paid sick leave. So even though the first 2 weeks under FMLA is not paid, essentially it is paid because that same reason is qualifying reason number 5 under the emergency paid sick leave. And regardless, because these reasons under both acts, because the reason she needs leave to take care of her daughter, that is paid at 2/3 her regular pay. And for those 3 days that she has, she can use that PTO before she uses her other paid sick leave under this act, but she's not required to. So the act says that these sick leave benefits under both emergency paid sick leave and under the Emergency Family Medical Leave Act are in addition to benefits that the employer already offers. And I think there was a question that popped up. Let me see if I can answer that. The question is, would these 2 weeks count toward her time of employment of 20 days to then receive emergency FMLA? And the answer to that is yes, because that person is still an employee and is technically still, accruing days of tenure at your organization. And we'll just go through a couple of frequently asked questions. We already kind of went through this, but if you have fewer than 50 employees, there is a possible exemption. but the exemption will not apply to other provisions of the emergency paid sick leave other than the child care related leave. And keep an eye on the Department of Labor website because they continue to issue guidance to employers on the criteria that it's going to consider for establishing exemptions. So they've updated that guidance, I think, 3 times in the last 5 days. So we at Fisher Phillips have been keeping track of that. If you go to fisherphillips.com, the landing page is our COVID-19 Resource Center, where you can have all of this information provided to you at no cost. And of course, if you have more specific questions, we certainly can help you and find the best solution for you under these laws. Furloughs. So furlough versus layoff has been a frequent question that we've received. So the question is, if the employer remains open but furloughs. So furlough in this sense is the person's still on your payroll, but they either have a reduced number of hours or days of the week, or they're still employed, but they're not getting any hours and you're still maintaining their benefits. So if the employer remains on open but furloughs on or after April 1st, can the employee receive paid sick leave or expanded family medical leave? And the answer is no. So if the employer furloughs employees because it does not have enough work or business for employees, even if the reason is due to a government mandated closure, employees are not entitled to take emergency paid sick leave or emergency FMLA. So in other words, if you've got employees on furlough right now, and then April 1 hits, there was a period of time for a few days where there was confusion about whether or not once that April 1 hits, you would have to start paying those benefits to your folks who are on furlough. And the answer to that is no. And again, if you have 100 more employees and you're doing a layoff or a reduction in force or a reduction in hours that has an impact on 50 more employees, you need to work with your counsel to make sure that you are complying with WARN Act obligations, both at the federal level and for your particular state. So those are the frequently asked questions. Sarah, I'll pass it back to you.
I think we've pretty well covered. There's a number of questions, and I think Rachel's going to pull those all together and provide them to us to respond, kind of synthesize them down. The only other comment I'd make is on the existing SBA loans, there's also a payment coverage that we didn't mention. So if you already have an SBA loan out there, the payments are covered for 6 weeks by the SBA. So that was kind of a nice little side note. I don't know how many dealers have an SBA loan out there, but additional information. And if nothing else, I'll turn it back to Rachel.
Team, I cannot begin to thank you enough for scrambling to put this presentation together for us on such short notice. We know that you're also in the midst of all this craziness and that it's not easy. To everyone on the line, if you have any other questions, you can email them to me and I'll pass them along. My email is S as in Sam, OLIMANIR@AIADA.org. I've also seen everyone who has chatted and Q&A'd, asked questions under the Q&A bar. I have them, I'm recording them, and I will also pass them along. Slides will be distributed, and you'll be getting a recording of this webinar by the end of the week. For more information about AIADA, visit AIADA.org. Thank you, everyone, for joining us, and have a great day.